Hey there, welcome to another episode of Your Channel Name. Today, we're diving into a topic that's more important than ever in 2026, credit. If you're wondering how your credit score can shape your financial future, you're in the right place. Let's get started. So what's the deal with credit? Well, in 2026, your credit score isn't just a number, it's a key to unlocking opportunities. Think about it. When you apply for a mortgage, a car loan, or even a job, lenders, employers, and landlords look at your credit history. A good score can mean better interest rates, lower fees, and even faster approvals. But here's the catch. 62% of people in the US don't have a perfect credit score, and that's okay. The key is understanding how to build and maintain one. Let's start with the basics. What exactly is a credit score? In 2026, the average FICO score in the US is 710, which is considered good. But here's the thing. Your score isn't just about how much debt you have. It's about how you manage that debt. For example, if you have a credit card with a $5,000 limit and you carry a balance of $1,500, your credit utilization ratio is 30%. That's actually pretty high. But if you keep that balance below 25%, your score could jump by 10 points or more. Why? Because credit utilization is one of the biggest factors in your score, accounting for 30% of your total score. So, if you're carrying a high balance, that's a red flag. Let me give you a real-life example. Take Sarah, a 28-year-old who recently bought a car. She had a credit card with a $2,000 limit and a balance of $1,200. Her utilization was 60%, which hurt her score. She decided to pay off $500 immediately and then started using the card responsibly, keeping her balance under 20% of the limit. Within 6 months, her credit score increased by 40 points. That's the power of managing your utilization. But here's the next step, paying off debt. In 2026, the average American has $4,200 in credit card debt. That's a problem because carrying debt can hurt your score and your wallet. Let's talk about strategies. One popular method is the avalanche method. Pay off debts with the highest interest rates first. For example, if you have a $5,000 balance on a card with 18% APR, and a $3,000 balance on another with 12% APR, focus on the 18% one first. Why? Because that debt costs you more in interest over time. Take David, a 34-year-old who used this method. He had $10,000 in debt across 3 cards with APRs of 15%, 18%, and 22%. By paying off the 22% card first, he saved $1,200 in interest over a year. Then, he moved to the 18% card, saving another $800. Finally, he paid off the 15% card. By the time he finished, he had saved $2,000 in interest, and his credit score had improved by 35 points. That's the kind of impact you can have by taking control of your debt. But here's a twist. Sometimes, paying off debt isn't the only way to boost your score. Building credit history is also crucial. If you're new to credit, you might not have a long history, which can lower your score. In 2026, the average person has been using credit for about 12 years. But if you're under 25, your history is shorter. So how do you build it? One way is to start with a secured credit card. These cards require a security deposit, which becomes your credit limit. For example, if you deposit $500, you get a $500 credit limit. Use the card for small purchases, like groceries or gas, and pay it off in full each month. Over time, this builds a positive payment history. Let's talk about a case study. Take Maria, a 22-year-old who recently graduated college. She had no credit history, so she applied for a secured card with a $200 deposit. She used it to buy a $50 book and paid it off in a month. After a year of responsible use, her credit score jumped from 450 to 580. That's a 26% increase. And now, she's ready to apply for an unsecured card. But here's the thing. Building credit isn't just about cards. In 2026, more people are using alternative credit scoring models, like the CreditWise score or the Experian Boost. These models look at things like rent payments, utility bills, and even phone bills. If you pay your bills on time, you can boost your score without a traditional credit card. For example, if you pay your rent on time, you might see a 20-point increase in your score. That's a game changer for people who don't have a long credit history. Now, let's shift gears to something that's a big deal in 2026, securing a mortgage. If you're planning to buy a home, your credit score is a make-or-break factor. In 2026, the average 30-year fixed mortgage rate is 4.2%, but that's only for people with excellent credit. If your score is below 700, you might face rates that are 1.5% higher. Let's break it down. Take James, a 30-year-old who wanted to buy a $400,000 house. His credit score was 650, so he faced a 5.5% interest rate. That meant his monthly payment would be $2,500. But after working on his credit for a year, he raised his score to 720. Now he qualified for a 4.5% rate, cutting his monthly payment by $500. That's $6,000 saved over the life of the loan. That's the power of a good credit score when it comes to homeownership. But here's a tip. Don't wait until you're ready to buy a house to start improving your credit. Start now. If you're planning to buy a home in 2026, you should be working on your credit score at least a year in advance. That gives you time to fix any issues, like missed payments or high credit utilization. Another area to focus on is credit cards with rewards. In 2026, there are over 100 credit cards with rewards, but not all are created equal. Let's talk about how to use them wisely. For example, if you have a card that offers 3% cashback on groceries, you should use it for those purchases. But if you carry a balance, you'll pay interest on that cashback. So, the key is to pay your balance in full each month. Take Emily, a 29-year-old who used a rewards card for her daily expenses. She earned $300 in cashback a year, but she also carried a $1,000 balance at 18% APR. That meant she paid $180 in interest, which wiped out her cashback. To avoid this, she started using a zero-interest balance transfer card to pay off her debt. Now, she earns rewards without paying interest. That's a smart move. But here's a warning. Don't get tempted to open too many credit cards. In 2026, the average person has 3.8 credit cards. Opening too many can hurt your score. Why? Because each new card adds a hard inquiry to your credit report, which can lower your score by 5 to 10 points. Plus, having too many cards can make it harder to manage your payments. So, focus on quality over quantity. If you have a few cards and use them responsibly, that's better than having a dozen cards with high balances. Now, let's talk about identity theft. In 2026, credit fraud has become more sophisticated. Cybercriminals are using AI to mimic your credit behavior and steal your identity. For example, in the first quarter of 2026, there was a 15% increase in credit card fraud compared to the previous year. That's a big deal. So, how can you protect yourself? First, monitor your credit report regularly. In 2026, you're entitled to one free credit report per year from each of the 3 major credit bureaus. But here's the thing. You can request a free report every 12 months, or you can get one every 4 months if you're in a high-risk category. Use this to spot any suspicious activity. For example, if you see a credit application in your name that you didn't authorize, report it immediately. Second, use credit monitoring services. These services alert you to changes in your credit report and can help you catch fraud early. For example, if someone opens a credit account in your name, the service will notify you. In 2026, services like CreditWise and Experian offer free monitoring for people who sign up through their websites. That's a great way to stay ahead of fraud. Another tip, don't share your credit card information unless you're sure it's secure. In 2026, phishing scams are more common than ever. Scammers might send you an email that looks like it's from your bank, asking you to update your account details. If you're unsure, call the bank directly using the number on the back of your card. That's a simple but effective way to avoid falling victim to fraud. Now, let's wrap up with a few actionable steps. First, check your credit report once a year. Second, keep your credit utilization below 25%. Third, pay off your debt using the avalanche method. Fourth, use credit cards responsibly and pay your balance in full each month. Fifth, monitor your credit for fraud. Sixth, start building credit history early, even with a secured card. And seventh, don't open too many cards at once. Remember, your credit score is a reflection of your financial habits. By taking control of your credit, you're setting yourself up for a brighter financial future. In 2026, the opportunities are endless for those who understand how credit works. So, take these steps, stay informed, and don't let your credit score hold you back. Thanks for watching, and don't forget to like, subscribe, and hit the bell so you never miss an episode. If you have any questions or want to share your own credit story, drop them in the comments below. See you in the next video.